Welcome, everyone, to One-to-One Mining Investment America's Investment Leaders Discussion. I'm very pleased to have everyone tuning in live for our first live broadcast that will open this virtual event. We're going to run the first half of the session today as an open discussion among the guests, panelists, and then take some questions from you, the viewers, to finish up with. So if you do have a topical question for the group, please submit it by typing into the Q&A box that you'll see on your screen. It should be in the top right corner there. So I'm pleased today to be joined by a panel of experts with a wealth of experience across the natural resources and investment industry. Here to give us a snapshot of the health of the mining sector and share the buy-side view on some of the challenges investing in mining projects. It's my pleasure to welcome Jonathan Goodman, Chairman and CEO of Dundee Corporation, Warren Owen, President and CIO of Rosseau Asset Management, John Lamb, Portfolio Manager at Orion Resource Partners, and Farhad Tariq, who's the Vice President, Equities Research and Precious Metals at Credit Suisse. Gentlemen, thanks very much for joining me in your respective mornings. Some early starts there. Let's start with the big picture and then hone down in some of the specific investment-based topics after that. There's a pretty big election coming up next week. What are our panelists' views on how the outcome of this could impact the metals and mining business environment? Jonathan Goodman, Mr. Goodman, could you start us off perhaps with your views?
Sure. I think what you have to really consider is that we're all long-term investors here. So in the long term, this election's not really going to make much of a difference. And I'm not saying it's not going to make much of a difference to the world, but on the investing horizon, we're buying. There's two major themes that we're investing in right now, and both of them are happening regardless of who wins the election. The first one is the gold and silver investment theme, which is really being fueled by global debt deficits, the funding of the COVID-19 crisis, which is going to leave a lot of countries much higher in debt, and that's going to happen regardless of who wins it. And the second one is the world is trying to wean itself off of oil and gas, and we see battery metals and other low carbon energy as the future of energy. And once again, that is going to happen. Arguably, it's going to happen a lot faster on the Democratic side, particularly in the U.S. But it's going to happen either way. These two trends aren't dependent on who gets elected. In the short term, there's going to be a lot of noise, as there always is, regardless of what the outcome is, and the noise may be longer lasting. But long term, it's not going to have any effect.
Yep. Okay. Anyone else on the panel like to jump in there with points on how effective this might be, or do you agree with John's sentiment?
Yeah, I'll jump in. So we actually did an analysis going back 30 years to see the election impact on gold, and really the only thing I can tell you is leading up to the election, we noticed a little bit more volatility in the gold price. But beyond that, to Jonathan's point, it doesn't really matter which party wins. There was a slight edge when Democrats win, but I think it's within the margin of error. So I think what really matters though in this election is if there's a clean sweep, meaning if both House and Senate are controlled by a single party, that would be a scenario in which it's more likely that a significant fiscal stimulus bill gets passed in response to COVID. And if that's the case, I think that's very positive for gold, to Jonathan's point. Longer term, it's not really going to have a huge impact who wins this election. But I think for gold prices in the near term, a clean sweep by either party, and it seems like the polls would suggest a Democratic clean sweep, that would be positive for gold. And that's simply because a fiscal stimulus bill would get passed more quickly and it could be more sizable.
Yep. Warren, perhaps I could bring you in. Do you have any thoughts on results of the election, or perhaps whether that might impact some of the other metals as well as just the gold market?
Yeah, the U.S. Being the largest economy in the world obviously has a big impact on things. But on the base metal front, I'm really watching China and India. So can you imagine a world in the next year and a half, 2 years, where there's a massive stimulus program going on in India, China, and the U.S. all at the same time? in addition to that, you overlay the strong environmental push for electric vehicles and electrification of the world. So you have that incremental demand on copper. So it's tough not to be quite positive, because you've got, you overlay that, everything that is driving the price of gold will also be driving the price of a lot of the base metals, especially copper. So you got stimulus programs, you have the printing of money, you have the electrification of the world. So it looks pretty positive for me on the base metal front. And on the metals, on the gold side, I approach it a slightly different way. I'm more on the exploration of gold, exploration side for gold juniors, and I'm finding the last number of years we've just had a really tough time finding these massive gold deposits. So on a supply-demand basis, I just see us mining out lots and lots of gold every year, but it's getting tougher and tougher to find. So in order for this to continue, we need to have higher prices so that some of these projects that are currently marginal now will eventually get put into production. So that's sort of my view there on the base metals and gold. I'm obviously bullish on gold longer term. The inter-year swings, it's difficult to predict, because you got the central bank activity, which has a huge impact. And I'm not about to predict what the different central banks are going to be doing and their different policies. It's very difficult to predict that. But I do know short term here, this recent spike in gold, I'm sure has knocked off significant amount of demand from the traditional buyers of gold. And it's been sort of the US investors and big international investors that have stepped in and replaced them. And when they get bored of gold, who knows when that'll happen, we're going to get a short-term bump, but long-term, gold is going higher and higher every year. And I just see it on the supply-demand side. We're just not finding it. We're going to need higher prices to meet the demand.
Yep, absolutely. Okay, we'll come more specifically into the gold market in a bit. John Lamb, now, can I bring you in on some of the election commentary and also some of your points on the macro trends that you might be watching at the moment?
Absolutely. Thanks, Adam. I agree with Warren. I think regardless of who wins the election, there's going to be a wave of stimulus and investment spending coming out of this COVID as economies look to repair their financial and fiscal situations and get people back to work. I think that's going to be very bullish for the base metals, something that we're very excited about. Particularly when you layer on top of that the electric vehicle trend and other applications that really are going to put a lot of stress on bringing new copper projects, new nickel projects into production, where there hasn't been as much in the discovery and development pipeline as you would have expected, given the lack of price performance over the last decade in the base metal. So I think it's setting up for a very, very strong run, regardless of who wins on the base metals in the back of those stimulus investments. On top of that, with the amount of money printing and low interest rates, I think precious metals are going to see outperformance as well, regardless of who wins the election. To Jonathan's point, this is a long-term game. It takes a long time to build a mining project, bring it into production, and looking to make returns as investors over a long period of time. Really not as concerned with who's going to win an election year over year, but what are the underlying trends? And I think the trends are shaping up to be very positive over the near term and the medium term for precious and base metals.
Excellent, absolutely. One point then around some of the macro factors that I wanted to address was the strength of the US dollar and how that might fluctuate looking into next year. And how does the panel see that developing, and in turn, how might that affect the mining projects that you've got that you're holding at the moment or that are going into construction?
I mean, I'll take this because no one jumped in before me, but the reality of this is that like Warren, we tend to invest in more junior companies, but we do a lot of due diligence. Like we for most of our investments, in many cases, we would sign a CA and we would do a deep dive look at how their resources are constructed. Because the reality of it is, I mean, one of my personal frustrations is that we all get on panels like this and we talk for 50 minutes on the US dollar. And the reality is none of us have a clue what's going to happen to the US dollar. You know, we can hypothecate their debt levels are coming high, and the world's would like, a big part of the world would like to see them lose their role as a reserve currency. But the reality of it is, if you can get an ore body that's going to be in the top 25% of the cost profile, great mines make money throughout the business cycle. So why not focus on investing in really great assets and spend less time worrying about some of these macro trends? You need to look at the macro trends. You got to know when you want a little bit of wind in your sail. But at the same time, if you're in a hot market and you get it completely wrong from the technical side and the when I say technical, I'm talking geology and mining engineering and metallurgy. If you get that right and you have a good asset, it's gonna survive all the macroeconomic noise that the world throws at you over the course of a cycle.
Yeah. Okay. Well, there's two key points you touched on there, but just to come back to you on your point around the assets, so do you find in this current market there are enough good quality assets out there? And with that, how's your due diligence process been this year, sort of filtering through or finding these projects?
Truthfully, I mean, I understand where Warren's coming from. I can feel his pain often. Where we're finding the better projects is mostly in the Australian market right now. We find that the quality of a lot of the technical work is much higher there. And a lot of those projects are making it through our due diligence process a little easier. But the reality is there are good assets, but you really sometimes have to undress them before you look at them again. A lot of the management teams that show you assets often have it wrong. They often, a lot of companies are looking to find the next great big one, and what they're missing is that they embedded in that next great big one is a really spectacular little one or medium-sized one that they can get a quick payback on and then possibly expand later. So I think I think that one of the challenges is that there's a lack of really capable, seasoned technical people. We're missing a part of the market because of our education system let us down, and for a period of time we got a lot of old mining engineers and a lot of young mining engineers, kind of that middle of the pack that's missing. And I think it affects the way a lot of them can look at projects and break them down.
Yep. Okay. Anyone else on the panel? Could we flip over to get your thoughts on that? Do you agree that Australia is where a number of the exciting projects are right now? Warren, perhaps you have something to respond to that.
Yeah, I just find, there are some good projects in Australia. I'm involved in a few, and I'm also seeing good projects, around the world. Australia, I find for myself, it's a really difficult place to operate. Night and day is reversed. It's tough to get hold of people. It's a long way to travel. With COVID, it's very difficult to get over there. But we are involved in a couple really interesting situations. There's been there's some good projects there around the world, and in Australia. I just find Australia, for myself personally, I find it a difficult place to invest. Yep. But what surprised me though here is I think you've got a situation here where a lot of people have been keeping some really good little projects in their back pocket until a better gold market, and we're starting to see some of those come out right now. They're finding shells are taken in public. And I've actually been quite impressed with some of the new projects I've seen. They're not that super advanced because the mining sector has been starved of funds, especially in the gold sector, for quite a number of years. So, but it's really interesting to see these guys, these mining entrepreneurs, pulling these projects out that've been sitting on the back burner for the last 5 or 10 years, and they're yanking them out and they're showing them to me, and I go, well, that's pretty impressive. And there's some interesting new ideas, and with respect to the base metal front too, with respect to new structures, and it's good to see the excitement back in the sector where people are willing to take a bit of risk and take a punt on some of these new theories, these new projects, the new regions that perhaps haven't been fully explored. And when you go around the world, it's incredible how many times you'll find a a massive mining property right next to a mine that's been in production for 100 years, and hardly any exploration has been done on it. And I'm backing some in Scandinavia right now, and it's just fascinating what's available. And I'm very hopeful there, because you've got, with respect to, let's say, geophysics, you're able to ground truth a lot of that geophysics by just flying over the existing properties that already have discoveries. And if you find that you've got similar structures and on your property, it gives you quite a good feeling that you might have a shot at finding something, because you're in the neighborhood, you're getting similar geophysical signatures, and it's worth a punt, that's for sure.
Yeah, so brownfield exploration or greenfield that's quite close to existing proven mine sites,
Yeah.
mine bodies. Yeah,
Oh,
okay.
there's some exciting names out there, and I just was pitched one yesterday, and it was I was impressed. And I'm continually impressed, which is good.
Good. That's encouraging signs for the exploration. And John, just coming back to the original point, John Lamb now. What do you think about the volume of companies out there? What's the private equity and royalties perspective on this? The quality and the volume of good assets out there, how your due diligence is going in terms of filtering those?
Yeah, so I think to Jonathan's point, you gotta look at a lot of pigs before you find a real winner. Our standards on the due diligence front haven't really changed, despite the run up in commodity prices. It obviously brings more projects out of the woodwork as companies can attract capital to advance the projects to the point where we'd be looking to invest. One interesting thing is we're looking at our portfolio over time is we're seeing an increasing amount. Our capital is increasingly competitive on projects that are already producing or closer to production as time has gone on, which is in some respects great, because you're getting immediate exposure to the commodity price. Certain elements of risk are off the table. So that's something that we have noticed and have been able to capitalize on and take advantage of. I think that the challenge is always going to be to find good projects at scale in good geographies, in commodities that have a good outlook, and you kind of have to pick two or three of those criteria as what you're going to see as the most important in a particular deal, and probably have to make compromises on the rest. And I don't think that's going to change. I think you're going to be looking at an increasingly competitive market for new projects coming online as they're chasing after the investor capital in these elevated price environments. Hopefully that brings in additional investor capital to do more exploration, more de-risking, because ultimately that's what these projects really need to succeed and come into production.
Yeah, certainly. Okay, excellent. That's a good opener there. Why don't we hone in now a little bit on the gold market? I want to bring Fahad in maybe to give us your thoughts on the sector. I note that you recently been rated #1 by institutional investor on the equities analyst side, specifically for precious metals. So we're well placed to get a good view here. What's the overall health of the gold sector looking like now? And on the balance of things, it seems like generalists and the large pension funds might not be flocking back to the sector just yet, despite this really positive price environment. Do you have any thoughts on that?
Yeah, so I mean, look, I think that generalists are starting to get back into the sector. I think generalists are still largely very underweight gold and gold equities. And part of it is there's some legacy concerns, because the last time gold prices were high in 2011, 2012, a lot of these large gold companies did very silly capital allocation, did really expensive M&A. And for a long time, and in subsequent years, there were massive write-downs, billions of dollars of write-downs. And this was across the board. And I think that really had a lasting impact on generalist investors who basically ignored the gold sector for a number of years. And then, in 2019 and this year, gold prices started really picking up. And you're starting to see, or at least from what I can tell from the inbound calls that I'm getting, way more interest in terms of trying to get a better understanding of what the sector is like now versus back in 2011, 2012, and starting to see some positioning. So if you were to ask me before COVID, I would have said most of the investors I'm talking to, the generalist investors, they're starting to do homework on the sector, but not necessarily positioning. Now I would say I'm starting to see positioning, but still significantly underweight relative to any of the indices, and just relative to what I think makes sense in terms of a percentage of gold in the portfolio. So I guess the short answer is still underweight. There's interest, but we're still in the early innings of investors really seeing management teams showing that discipline. It's only now that these companies have started generating significant free cash flow, Q1, Q2, and really now you're going to start seeing it in Q3, Q4. And so I still think that investors are kind of slowly treading the water and trying to get a sense of, will there be that discipline that was lacking the last time there was a gold bull market? Will we see more capital return to shareholders while also still investing in new projects in a smart way? And so I think you're going to start seeing that positioning increase. But as of now, I would say the interest is there, but generally underweight gold.
Yep. And with that interest picking up, do you think it's going to be the majors? They seem to have sort of had derated a little bit lately after a very good year overall. Or do you think it's sort of the mid-tier projects that have got that bandwidth to grow and can't come into real share price appreciation? Where do you think the interest would lie?
Yeah, so look, I think there's no denying that generalists like to be invested in large, diversified producers, both on the gold and base metal side. The last thing an investor wants is, gold prices are going up and the company they invested in has one or two mines, and one or both of those mines have operational issues. And so they don't get to participate in that gold price increase, really, right? That's the last thing an investor wants. They want torque to the gold price. And so I think right now the interest is generally among the larger producers. However, I would say that as gold prices increase, and we saw this a little bit in the summer as well when gold prices were higher, I did start seeing more interest in the mid-cap and in some cases junior mining names as well. But generalist investors right now predominantly are looking at the larger cap companies, Newmont, Barrick, Agnico Eagle, and they're starting to look a little bit more at the intermediate gold producers, which I would argue present a far more significant value proposition. The multiples there are nowhere close to what they were before. And so there's definitely more torque and outperformance opportunity in the mid-cap and intermediate gold space. Yep.
Okay. Excellent. Jonathan Goodman, then, just coming to you and the sort of companies that you look at and the projects that you develop and hold within the gold space. Does it really matter then that at the moment that this generalist capital isn't quite there? It's quite underweight. Is this this is a time of plenty for the junior gold miners? With their valuations looking good. What's your thoughts on gold miners there?
In the short term, the answer is no, it doesn't matter, because you didn't expect them to come back. And most generalist investors really aren't equipped to manage portfolios of juniors. And every time they've tried, they've been the guys holding the bag at the end of the day. And that's one of the problems we have as an industry, is that in serious investment circles, let's take the word mining out of it, in serious investment circles, our industry is seen as an industry that lacks credibility. Fahad mentioned that the producing companies made some horrible capital allocation decisions last cycle, and that's true. For the most part, that part of it's been fixed, and you're seeing companies start to pay dividends, make more responsible capital allocation decisions. But the second part of it, which is what happened with the junior mining companies, and for the most part, the technical work done by junior mining companies. And keep in mind, as investors, most people see PEAs and feasibility studies and pre-feasibility studies. And for the most part, the work that went into these during the last cycle was complete crap. They were really, really poorly done. Very few companies were ever able to build a mine that lived up to its report. From a geostatistical point of view, I think a PEA is supposed to be plus or minus 40% on a capital cost guess. But if you actually took all the PEAs and lined them up and then took the feasibility studies, the thing, you should be seeing where the actual capital expenditures in a feasibility study should be within plus or minus 40%. But there's very few feasibility studies that have ever come in minus. And so PEAs have become these aggressively done marketing documents. And at the end of the day, the reason this is important is if we ever want to attract a whole bunch of people outside of our little circle of investors that trade stocks with one another, we got to actually start putting out quality information to the public. So I usually tell CEOs of companies, why don't you pretend that the people that own your shares are actually the owners of the business, and talk to them as if they're owners rather than people you're trying to spin. And I think it's a real problem long term if the mining industry, especially as we look at the global macro trend as an industry that's trying to get, we're going to produce enough nickel and copper and lithium and zinc and all these metals for batteries, and probably nuclear energy will come back and we'll have more uranium, and you take it right through and you look it through all the demand that solar energy is going to be for silver and some of these other metals. If we're going to enter an era like that, and mining is going to be kind of the solution to climate change, we got to become way more professional as an industry and way more accountable and more honest with our with owners of these businesses. And so that's why we tend to have a very open dialogue with the managements we invest in, but we want to see people who aren't afraid to sit down, roll up their sleeves and say, hey, here's our problem. Here's how we think we should solve it. What do you think? Yep. Investors are still making a decision. If someone came to you and said, look, I've got an asset that could be worth $1 billion, my market cap's $75 million, and here's my problem, and here's how I'm going to solution, and it might take me 4 or 5 years. That's a really, if you analyze and say, we think you can de-risk that, we think you can solve that, that's a really good investment proposition, provided that they can roll up their sleeves and solve the problem. So yeah, I think we need a little more integrity and honesty across the whole junior segment.
Yep. So it's a news flow problem to some degree, and the quality that's being put out of that. Okay, Warren, do you have any thoughts on that with the communicational values of the junior mining companies that you hold?
Communication, yeah. I have a bit of a reputation for calling management out on things like this, so it's gotten me into a bit of trouble. But yeah, there are a number of liars out there, and I call them out when I can. I call them out publicly when I can. Whenever I meet with them in public, I tear a strip off them. So I try and do my part, but there's a lot of lying. Old habits die hard. A lot of the older gentlemen in the business have old habits which are pretty bad. And I'm seeing, unfortunately, some of the newer guys joining in the business. They will BS almost as much as the old guys. They almost look at the old guys and, well, this is the way I'm supposed to do it. Or in certain instances, you'll have cases where a young mining entrepreneur's father was in the business. So he thinks, well, my father lied. And so I'm just going to continue along that trend. So that's sort of, that's a bit discouraging, but you'll see, you see some light. There are some good, decent, honest people in the business. And I try and gravitate towards that. We had an instance the other day, I won't name the name, but we had the CEO just came out in a press release and just blatantly lied to the world. And, of course, we had to put a press release out to correct that complete and total fabrication. And, how many industries does that go on in? And, it was an issue where basically all you have to do is read the agreement. Well, agreements are available. And if you're telling people and telling investors that something's black when it's really white, and you're doing it in a press release, and then you have to be corrected by a third party that is indeed not the case. And with that particular CEO, it happens fairly regularly, and we just call him out every time he does it. But he'll never change, and you're probably aware of the 50 points I put together the other day for some newbie investors about 50 things I look for in a mining stock to see if it's a scam or not. Or yeah, so there were a lot of items there in that list of things to look for when there's scams, and that list was put together after 30 plus years of working in the mining business and seeing all the scams. One of my favorites, as I point out to people, is this one CEO who had a separate company away from the junior he ran, and it bought a few pickup trucks. And it was renting these pickup trucks to the company by the hour, and that nonsense needs to stop. I remember one in particular. I think he was charging $400 a day to rent one pickup truck, because it wasn't a pickup truck, it was an ambulance, because he'd put a cap on the back and a stretcher in the back of the pickup truck. So that was now an ambulance, and he was able to get $400 a day, from to strip out of his junior company, by saying there's an ambulance. Has anything happened to this guy? Absolutely not. Nothing's happened. Everybody in the business with half a brain knows who he is, knows he'd never back him, but there's a lot of that nonsense goes on in the business, and it's not at all prosecuted. And so I view it as my job to make as many people aware of as many scams as I've come across in my career, so that at least they'll question some of the activities in the junior space. But as far as a lot of things Jonathan has said, what's interesting is all this stuff is self-correcting. If there is demand for copper, there is demand for gold going forward. We'll find it, and it might not be pretty how it happens, but it'll get found and it'll bring to market. It may not be as cheap as it would otherwise if we had a more efficient and more honest and more experienced industry, but we'll find that, and it just might not be as pretty as it could be. But sometimes I know we beat ourselves up as an industry as being given that, especially in the junior space, about them being dishonest. But I've been active in some other industries too in my career, and once you get to know an industry extraordinarily well, you find all the tricks of the trade, and you'll find that there's a fair amount of dishonesty in quite a number of the businesses, whether it be tech, whether it be oil, whether it be mining. There's some sketchiness in all these industries, and we just have to do our part. We just have to do our part in the mining. If we see levels of sketchiness, we just call the people out. We get rid of them. Another CEO just left the other day. He didn't leave in the way I would like him to leave. I think he should have been completely and totally disgraced, but he was allowed to retire from the company for the things he did. Well, I don't think that's the correct way to handle it. Hopefully, if that happens in a few more years, we'll be calling out these CEOs, and we'll be in the press releases. They'll say exactly what happened rather than saying he's off to pursue other interests or retire.
Okay, that's good.
If I can just elaborate on one point, because to me, the other side of that issue isn't what I would call the straight up lying and dishonesty issue. It's what I would call the aggressiveness of assumptions. And people need to understand, when you have, we're still estimating how much gold is in a ton of rock by basically putting a few pinpricks. So one of the guys I used to work with said it's like taking a loaf of Raisin Bran and poking some straws in it and trying to guess how many raisins are in it by what's inside the inside of the straws. And so when you have the little assumptions like how you cut grades, how you block size stuff, and how you do different things, those get expanded over much larger areas. And those small assumptions, which are often done by outside consultants with a lot of pressure from management, have really, really large effects. And that's why our view is that when it comes to resources, you have to really sign a CA and take a look and see how they're constructed, because the problems, it's not that the CEO is lying to you. In many cases, the CEO doesn't even understand what his resource means. But unless you can actually go back into that resource, you can't pick up a PEA or a pre-feasibility study or a resource report and figure out where the problem is. You really need to get into it deeper. And in some cases, the other side of the story is there's huge opportunities that you can't see in the publicly available information. So I think we need to put a lot of pressure on the companies to put out more information. Like, if we're the owners of the businesses, why isn't all the data online? There's nothing really that proprietary. And if it was all there, we'd have a much more efficient market. But if my guys can go into the models and look at them and figure out where there are opportunities. An example is within if you have an open pit, any intersections that are outside of that open pit, they create a conceptual open pit, are taken out of the model. Well, a lot of times we go in there and we say, wow, they've got an ore body under that conceptual open pit. It's probably a nice little underground ore body, and you just don't even see it because it's in its zero in the models. So for us, those are great opportunities. So I think it's the lying is one side of it. On the other side, there's a lot of other things that can catch you. And as I said before, for the generalist investors that don't have the technical know-how to weed through this morass, they're not. A lot of them aren't going to come back to this industry because every time they've come into it, they've been the ones holding the bag at the end of the day. And if you stay too long at the party, you wind up cleaning the ashtrays. We need to treat it better.
Very good. Okay, we've covered that point quite extensively now, and all, of course, very valid. Let me bring John Lamb back in here. John, what's the private equity sort of take on some of those points quickly, but also, as owner of a company, what is the message that you're perhaps sending to the companies that you're owning right now? What would you like to see of them now?
I think, first of all, completely agree with Jonathan and Warren in terms of the lack of information provided in the public market and the quality of some of the information that is provided and some of the characters there. But I think where mining stands out as unique relative to tech or some other sectors where companies mature and kind of go through several rounds of private investment before coming public. It's kind of backwards in the mining industry. Guys get their hands on a project and immediately public and trying to raise money out there without fully testing the project and really having the model scrutinized in private. So that's something where frequently we can make an assessment on whether or not we want to spend more time looking at something, whether it's interesting just by seeing who's involved, seeing how much work has really gone into the project and try to allocate our resources appropriately there. So I think that's the number one challenge. In terms of my communication with management teams, we like to stay up to speed on developments and work collaboratively with management on addressing problems before they metastasize. So the key is, if there's something that could be an issue, let's talk about it. Let's do some work together on it, figure out what it's going to take to fix it, as opposed to having it blow up one day and being really too late. I think this is definitely a case where an ounce of prevention is worth a pound of cure. So I think frequently there's been a push by management teams, particularly when the price has been weak and capital has been scarce, to kick problems down the road and worry about it later. I think that's the wrong approach, because if it's a problem, it's going to be a problem. It's going to be easier to fix before you start building building assumptions off of that bad assumption.
Okay, excellent. Thanks, John. Okay, look, we're racing through time here, and I've got a couple of questions coming in. In fact, someone's already asked for your 50 points, Warren, if we'll be sharing a link. Yes, we can share that round to the participants after this session. But before I come on to some of the Q&A, let's just get everyone's view around M&A now, because I think we're at quite an interesting period there. Would you as investors like to see more M&A? What do you expect to be coming this year? Is it going to be very much gold sector specific? Farhad, could I start with you there?
Yeah, so maybe I'll talk about from the gold side. Look, I think if you look across the spectrum of companies, do I think there's going to be massive deals among the senior gold producers? Probably not. They have largely done that already. If you look at Newmont and Barrick and anyone else that's kind of in that senior gold producer bucket, I don't know if they're necessarily looking to do deals because that's not part of their strategy and has never been in the case of a company like Agnico Eagle, or they've invested significantly in organic growth projects and bolt-on acquisitions in the case of Kinross and, for example. And really, I really don't see any senior gold producer, doing a massive deal. I know Barrick's been in the news about Freeport, but who knows if and when that will happen. So I think, to answer your question, I think the M&A consolidation theme will continue, but it'll be more pronounced among the intermediate gold producers. That's where I see an opportunity for companies to combine, become larger, partly to become more relevant to generalists, and also just because you need to see economies of scale. I think a point that's been mentioned a few times on this conference is that exploration is lagging. Reserve growth is an issue, and it's going to catch up. And part of the solution is that, or part of the problem is there's just too many companies going after too few ounces in the ground. And so, to the extent that you see M&A happening, for sure, it's going to happen, and it's going to happen in, I think, the mid-cap gold space. And I also think you're going to see a lot of the senior and mid-cap producers also acquire junior mining companies, to get that reserve growth if they see a promising project that's in a jurisdiction that they're already in. So broadly, those are the kind of themes I see.
And that's from now, or is that sort of a 2021 view?
Yeah, good point. So from a timing perspective, I think you touched on this earlier. Due diligence is a problem. I've heard this from royalty companies. They're trying to do virtual due diligence, but it's hard because on-site due diligence is a big part of the process. And I think unless you've looked at the company and done that work before COVID, it is hard to close larger deals during this time. And I think that's why you haven't seen much happening recently. I think talks are happening. I think there's some initial work being done, but it might be something that kind of gets pushed into 2021 in terms of from a volume perspective. But I think those conversations are happening for sure. I just wonder if the deal will only close once there's more ability to do some on-site due diligence. Anecdotally, I would say that is a bit of a deterrent, I think, for some companies right now, is they're having those discussions, but they just don't feel comfortable because they haven't been able to visit the site.
Ostensibly,
Adam, is how much due diligence you can do virtually. I think that's something I don't think people really understand it, because we've always been kind of old school, saying you have to go to site to get 90% of the stuff done. The amount of it, you still need to get to site. I'm not going to go that far, but the amount of stuff you can do without going to site has really changed. Most companies have high resolution cameras and drilling out their core. You can actually look at the geology. You can look at the core. There's a lot of stuff you can do with the technology that's available now. It's pretty incredible.
Yeah. Ostensibly, a lot of the gold companies have got extra cash flow, with this, with the price increases over the last year. Do you see that then going into exploration spend as shareholders? Do you want this to go into building out the construction of their projects, or do you think this is going to be saved in order to instigate this wave of M&A that we might be seeing next year?
I think it's going to be careful, because companies and their boards and their managements have very, very strong capital discipline right now. So I don't think you're going to see the mega acquisitions that everybody seems to be talking, because they really have to show a return to shareholders. And I think you're going to see a lot of excess cash flow be used to dividends. You will see some what I call tuck-in acquisitions, where an area where, as Warren said, there's a mill in the area and there's a nice project in the area, and certainly the company that owns the mill has a competitive advantage to other companies. You'll see a lot of that. And I think you'll see companies continue to embrace technology, drive their costs lower where they can, and streamline things. But I don't think we're going to see M&A, because the market sent a signal. M&A for the sole purpose of M&A is going to get resisted by the market. You need to actually have a reason to do. There needs to be some value add to the piece.
Yep, certainly. John Lamb, what's your thoughts on M&A?
I think the industry has shown a market increase in discipline, and that's been very, very good to see. I think something that I've encouraged the teams that we work with is you don't change your discipline just because the price is a lot higher and things look a lot better today than they did a year ago or 2 years ago. It's important to realize that the price is good today. It might not be good tomorrow. Don't be spending cash on things that you're not going to see a return on. That being said, I think to Fod's point, there's clearly a demand, particularly as we see increasing generalists in the space, for consolidation. I think that's going to be important, particularly if we expect to see generalists to seek a home in mining for the longer term, to have more consolidation, larger companies that are that more liquid is going to be important, because I think it's very difficult for a generalist to even discern at the mid-cap level between some of these companies and what the quality of the asset base is and what the where they would want to put their money to work and earn the best return. It's just too difficult without really spending a lot of time on it, and then maybe the boat has sailed. So I think having more consolidation around that, and where we've seen the zero premium all share mergers, I think that makes sense. Nobody is putting their balance sheet under stress. There's increased liquidity, which hopefully will reduce the cost of capital for companies. But the key is to think about what makes the most sense, apply good discipline as companies have been over the last several years, and then coming out of this, when the price does come back down, it's not going to be amplified by everybody being over levered and needing to sell assets or having their balance sheets under pressure, because that's where a lot of people really got into trouble the last time, because you have a declining price and then these balance sheet pressures that really erode shareholder value.
Yep, certainly. We're blitzing through the time here, but Warren, what's your thoughts on M&A? If you could just give us a quick 1 minute on, do you want to see more M&A? Do you want to see things picking up?
Yeah, it's not really what I want to see. M&A goes in cycles. I used to work at M&A in investment banking right out of MBA school years ago, and it's all in cycles, right? People make stupid acquisitions at certain parts of the cycle, then they get disciplined. They say, we'll never do that again, and we'll focus on our core operations. Then they make a ton of money. Then investors start hassling them, saying, well, you need to make acquisitions. We want to see growth now. So investors are sort of schizophrenic a little bit. And a lot of it happens where you've got people who aren't familiar with the mining business, and I think there'll be pressure on the big companies to replace reserves now that they're generating large amounts of cash. And I think next year is the year it's going to happen. There is a big mining M&A building here. I'm seeing it firsthand, where these companies, they know they're in the extractive business. They are every day they're mining what they have, and a lot of them cut their exploration budgets years and years ago, which I'm not a big fan of them doing that, but they have. So they're relying on juniors to fill that to refill their coffers with respect to reserves. So now will be the time to do it. They're filled with cash, and valuations aren't super crazy. They've got to go out there and buy the tuck-in acquisitions and the ones and sometimes larger ones that'll replace the resources they have. I know one company that I believe will be out of business in 10 years if it doesn't make an acquisition of significant size. Well, that's reality. And every day goes by, there's more and more gold being mined. And if these majors are not replacing that through internal growth, brownfield exploration, they're going to shrink in size. And I'm seeing companies that will be shrinking, and some companies that I don't think will exist if they don't do M&A. So now's the time to do it. They're making the cash. It's ancient history, all the screw-ups the mining companies made in the last M&A cycle. So I think we're heading into a really good M&A cycle next year. Without a doubt, COVID has slowed things down quite considerably. I know a lot of instances where international companies are ready to buy, but they cannot meet with the CEO. They can't get on the site visits. So that's slowing things down. So I think there'll be a big rush for M&A next year. It'll be a huge year for M&A.
Just to play devil's advocate, Warren, do you think there's a lot of juniors that perhaps don't want to sell right now because they can raise the capital in the equity markets, which have opened up a bit more this year? They're looking slightly at a better environment for capital raising. Do these CEOs want to be out of a job that quickly? There's
a price for everybody. And if you are a CEO and you could get a a double on your price today, and you know that the market's still robust and you can start a new junior with that other project you've kept in your back pocket. I think I don't know if too many mining CEOs, if offered the right price, wouldn't take the cash and recycle it into the next new opportunity that they have. And I think everybody would be a willing seller at the right price. We had a hostile takeover bid by Sol Gold against Cornerstone. It was a mean-spirited hostile bid, so we turned that down. But generally, I think most people with a friendly, fair, reasonable deal, they're willing to accept it, and they're willing to sell it, move on, because there's lots of opportunity in this cycle. This mining cycle is just getting going. There'll be many, many years of it. So I think the key is just recycle your money and get it back to work in newer names. So I'm totally supportive of it. Yeah.
Okay, very good. I've got a question here that I'm going to open up to the questions now from our audience. Does the panel see COVID-19 bringing change in the mining regulation towards higher royalties and taxes on miners, as the pandemic will heighten political risk and strain on countries' fiscal standing?
First of all, yes.
Go ahead.
Yes, the short answer.
But it's not just COVID-19. It's also prices. Eventually, higher prices. I mean, look at the oil and gas industry. I mean, we have royalties in the mining rate, much lower rates. I mean, as prices get high, I mean, you can't move a mine, and so that's why politics is so important. People are worried primarily when they worry about political risk. They're worried about the wrong thing. They're worried about risk of the country taking it away from you. They should be worried about the country taking away from you by higher royalties and taxes, and that's a risk that we face as an industry as we achieve success.
Yeah, I think Jonathan hit the nail on the head. I think this is a function of not just fiscal deficits because of COVID and governments trying to balance the budget or at least trying to raise some more money. It's also a bit opportunistic in what the gold price is doing. And so we've seen a few examples in my coverage, for example, Barrick and its issues in Papua New Guinea. Would that have happened if gold prices were, cyclical lows? Maybe not. I do think you're going to see more pressure from governments wanting to take a bigger stake in mines. And I think for sure in some jurisdictions, you're going to see royalty and taxation regimes change. And part of this has to do with, again, there's parts of the world where that is more common and that can happen abruptly and that can happen very quickly if there's a change of government. And then there's other parts of the world where it's a stable jurisdiction. Like I can't imagine Canada is going to change their royalty structure overnight. Do I think parts of Africa that's going to happen? Absolutely. And I think that is a risk for some miners that have outsized exposure in those areas.
Okay, great. Unless anyone else wants to chime in on the tax side of things. We've got another question on ESG here, and we've not touched on that yet. Has the pendulum swung too far with regards to ESG criteria? And which performance criteria do the panelists want to see more of from a mining company, or which are proving harder to track? Fahad, do you want to give us your view on the gold tier?
Yeah, so this is timely. We just put out this morning a comprehensive gold ESG scorecard. I think it's the first of its kind from the sell side. And I think the key takeaway for me is I would like to see miners do a better job reporting on emissions, on energy use, on waste production. I think it's very easy for a lot of these companies to say that they're on board with ESG and then direct the conversation entirely to the G, to governance and to certain social metrics where they perform really well, and to kind of ignore the metrics where they don't do so well. I think an honest and transparent discussion is what needs to happen. Your initial question was, has the pendulum swung too far? I think there's a lot of attention on ESG. I worry that some of it is going to become superficial, and that it's not really going to be a substantive change in the underlying operations of the company. So what I would like to see is a more specific focus on the environmental impact and being more transparent about reporting that. A lot of companies don't even report some of those metrics. And secondly, to really try to redirect the conversation away from just the metrics where they perform well to a standard set of metrics that maybe all gold companies should report.
Yeah, is this an issue that the whole industry is experiencing, this fragmentation of reporting standards? John Lamb, perhaps I could bring you in here. What are your thoughts on reporting standards, or what are you asking of the companies that you hold in terms of ESG?
So I think, ESG is a major focus for us in due diligence after you look at, what's the technical quality of the project and who's the management team that you'd be working with. ESG is right up there on that, because it can generate headline risk. It can also impact how successful you're going to be in executing on the business plan, and you want to maintain a good reputation with regard to the environment, with the local community, and with the governments in which you're operating. So, to answer your question, has the pendulum gone too far? No, I think it's been an area that's been neglected. It's coming into focus now. I think for a while there was a lot of superficial focus. I feel like it's getting more real as more investors are focusing on it. And I think it's important for investors to be asking these questions and spending time on it, because that's going to cause the management teams to be focused on it as well. I'm not sitting down in the chair running the business on a day-to-day basis. I can ask questions and make decisions for my own accord. But I'm counting on having partners that are going to be on the ground implementing that. I think no project is going to have no environmental impact, but it's important to understand what that is, what the current state of the project is, particularly on brownfield projects, and work to put together a robust plan on the environmental side and execute on that plan. It's not going to be the case that every standard is checked day one, but have a plan to work through the outstanding issues on the project, so that you can be successful in developing it, because that's going to lead to better relationships with the local community, better relationships with the government. And when you want to build an expansion or the next project there, you're going to have those people engaged and excited to see the economic opportunity, as opposed to opposing that project.
Yep. Warren, what do you see as most critical for yourself? Is it the emissions side? Is it this community relations issues? Is there an area that you want to see more from your companies?
It's an interesting area. I'm generally not dealing with companies that are stuck in the whole ESG quagmire. I had a conversation about ESG the other day with a friend of mine who has very close ties with one of the world's largest mining companies, and they're just bogged down in the quagmire because they've got senior executives that are being measured on ESG. Well, how do you do that? And as Fuad said, there's no standard. There isn't. It's almost impossible to standardize it. And they have their top 100 investors are all concerned about ESG, and they have to create 100 individual reports for the top 100 investors on ESG, each one wanting a different set. Because there's no standardization. So it's a bit of a quagmire. Fortunately, that quagmire has not gone down to the juniors I invest in quite as much. Juniors have always been on the exploration side. They've always been very cognizant of how important it is for community relations and social justice, building schools, building hospitals, and making sure that the community directly impacted benefits from it. The environmental side, it's crazy what's going on environmentally and what's happened over the last 50 years. If you look back, there's an argument that Greenpeace has harmed the environment many, many more times than it's helped. For instance, with its anti-nuclear stance back in the 70s, it shut down nuclear research for 50 years. So what have we done? We burned coal for 50 years, half a century of burning coal that didn't need to be done because of Greenpeace fighting nuclear. Well, here we are now. We're realizing we're half a century behind in R&D with respect to next generation 4 nuclear reactors. And now we're figuring that out now. We've got Al Gore, Mr. Environment, in his renewables, even his renewables definition does not actively support nuclear. So on the environmental front, it's pretty nutty. And here's another example. Let's say there's a hypothetical country that's looking at a massive new copper project. And what do you have? You have a bunch of environmentalists fighting it. Well, you're fighting this new copper project, but guess what we need copper for? We need copper to electrify the world, to get rid of CO2 emissions. Yet you're fighting it on the ground to build this copper project, which is in the middle of a desert, won't impact anybody. But because you're an environmental group and you're anti-mining, you're fighting mining. But mining holds the key to improving our air quality. Yet you're fighting it. So there's a lot of cross forces that don't make any sense. And we've seen how Greenpeace has harmed the environment the last 50 years by being anti-nuclear, how Al Gore has harmed the environment by not supporting nuclear. And you have environmentalists fighting copper projects that are in the middle of a desert that don't impact anybody or anything. And the future, we need copper, frankly. And anyways, that's sort of my spiel on the environmentalists.
That's good. You know, to add to that, I had an anecdote from an S&P podcast the other day. It says the world needs to wake up to get dirty to get clean, and I think that speaks to what you're saying around, you know, the need for the energy metals that are going to lead to a cleaner environment or a cleaner. And people are perhaps not making that connection. They're not thinking long term enough around that. That brings me to another question we've had coming in. It's the move towards clean technology and the metals that are going towards it, and actually. This question is asked around, are the investors feeling it might be timing to look again at rare earth elements? I don't know if any of you happen to hold or look at any of those, but is there any interest there? Is that spiking up? Or is this too much of a niche space to be making big returns on at the moment?
First of all, I mean, you need to have deposits for people to start looking at them. And it's very clear it's been made a strategic element, but you know, we don't see a lot of good junior companies with interesting rare earth deposits. But if I can step back to the ESG conversation a bit, and this
Absolutely.
is that there's not a project in any junior company that doesn't have an opposition group. And there's very few CEOs that come out and openly admit to it. And the reality of it is really good governance, really good environmental practices, and really good social practices are what protects a company from these, you know, the people that protest. Because at the end of the day, I don't think anybody else on this panel has ever sat in front of an NGO or met with the local mayor on these things. Every local mayor says the same thing. I want the project because I need the jobs, we need the economic boost, but I don't want the environmental effects that come from this. So as a company in the mining industry, if you have good ESG practices and you can get in there and work with the communities at every level, including the federal level, and have good environmental practice, good social practice, and good governance, you're going to work through it, regardless of what the NGO opposition is and all the other stuff, because at the end of the day, people need the jobs. And the other side of this COVID-19 is there's way more unemployed in this world. And a lot of these projects need to happen so we can properly train people and properly manage it. And they need to see modern mining. And modern mining can mine these substances in a very environmentally friendly way. And you know, so I don't think ESG has been overplayed. I agree that it can get a little tough at times, but I think it's also very key, particularly for junior companies, not as a box to tick so you can tell someone. I think investors are coming a little late to this game because mining companies have learned long ago is that we have to be transparent and open with our stakeholders in these communities so that we can get a social license and get these projects built.
Excellent. Yeah, absolutely. It harks to your original point in the beginning that mining, you know, is sort of built to be the driving force behind a global economic recovery, and it's certainly got a lot to step into that role, a lot to do. Just had some other questions, but we're almost out of time. We've had one on sort of exploration and regional focus. Could I just quickly go around the panel and say, just to wrap us up, exploration and hot regions, where are the exciting regions for exploration now? Is there anywhere new on the radar? We've had this question submitted by someone who said, what about Libya? What about North Africa? Or are we looking at the traditional jurisdictions that we know very well I'm very familiar with for their qualities, Western Australia, Sudbury, for instance. John, as we're on you, could you start us off?
Sure. So, for us, 75% of our portfolio is in what we call established mining jurisdictions, U.S., Canada, Chile, Australia, South Africa. And I think that's, we still see a good amount of opportunities there. The balance is in emerging geographies. I think we've seen, good success in some newer geographies in Latin America and in Africa. It comes down to a trade-off on the quality of the underlying project, and some of those countries can be quite higher. Some of the challenges operating there can be different. So really, we view it as an opportunity to kind of balance some of the risk in the portfolio, where maybe the projects are going to be a little bit lower grade in some of the more established countries, but the emerging markets can help offset that to some degree.
Yep. Okay. Fahad, what's the view from the gold space in terms of where's hot? Is it still West Africa that's looking really, really interesting?
Yeah, I don't know if I can point to a specific region other than to say, look, I think the easy gold in the world has been mined. I think you're going to find more underground deposits. I think you're going to find more focus on kind of these frontier jurisdictions, whether that's West Africa, the Guyana Shield. Agnico has a mine in Nunavut. Who would have thought, 50 years ago, there would have been a mine in Nunavut. So I think you're going to see just a general trend towards more of these emerging frontier type jurisdictions, just because everywhere else, if you look in North America, if you look at Australia, like a lot of these areas have been mined significantly. And so there's not much more potential there. The one thing I would say is, obviously, there's a concern that when you enter these frontier jurisdictions, that the infrastructure is not there. So, it tends to be higher CapEx projects. The mining, skills aren't there, so you have to train a workforce. So it presents a lot more challenges, and so it needs to really have the benefit of, let's say a high grade deposit, low cost, that's the general trend.
Yeah. Okay. Certainly. Warren, you mentioned Scandinavia before with some interesting projects. Where's interesting for exploration for you right now?
Well, for me, it's all about risk reward. I understand the politics of South America. For instance, Argentina goes through cycles of wanting mining, not wanting mining. A lot of countries in South America do the old circular thing. Well, we don't have any mining. Let's create a better environment for mining. Mining companies go in, find things, and next thing you know, the politicians want to steal it all, right? So that happens a lot in South America, happens in Africa. Some of the most amazing mineral deposits in the world are in the DRC, Democratic Republic of Congo. I've been there. I love the place on a mineral standpoint, but there's obviously significant amount of corruption that you have to grind your way through, operational issues and things like that. So that's sort of, I guess, the essence of it. Whenever I look at an opportunity, I look at, well, what's the reward and what is the cost of getting there and what is the risk of having it stolen from you, or and how difficult it is to operate. So it's all a risk reward. I don't rule out any, well, I do sometimes rule out different countries, but you have to watch the politics, how stable the politics are, and a host of other factors. We could almost have an entire session on that. But yeah. The two bookends, near as I could tell, is Saskatchewan, northern Saskatchewan, and one example as an amazing place to operate, and the DRC, amazing deposits, but extremely challenging to operate. And then there's other countries that you just can't operate in, for instance.
Yeah.
But those are the trade-offs. You make trade-offs, and sometimes you win, sometimes you lose.
Yep. Fantastic. Okay, well, look, we've gone 10 minutes over, and we've covered a lot of ground, and we could have gone into more detail on all of these topics, but actually I think that's given quite a good view of the risks present, but also the sort of opportune time that we're coming into within the metal cycles and the M&A cycle picking up. So I'd just like to say thank you very much, all of my panelists, for joining me in your respective mornings over in the East and West Coast. Thanks, viewers, for joining. This will be available as an on-demand video throughout the rest of the conference, and we'll release it through the assay and the one-to-one mining channels next week. So thanks everyone for tuning in, and have a good day.
Thank you.
Thank you.